Starosciak, Managing Partner with Infinium Investment Advisors. This is your market update for January 12th, 2012. Before we begin, anything that we discuss in this video is purely for informational purposes, not a suggestion or recommendation to buy or sell any securities or follow any strategy. Infinium does not provide tax or legal advice, and always contact your own financial advisor before making any investment decisions. So with that, 3 topics today. First, we're going to take a look at the markets where we're at currently, and then our second talking point is to look at the markets, namely the S&P 500 versus gold since the early fall. And then we want to ask you a question, and that is, are you potentially too conservative based on everything that's happened here as of late? So with that, let's jump right in. This chart here is the S&P 500 index as of the close today on January 12th. And I just ran about a 1-year chart or so, or back to the beginning of 2011. And we can see we started 2011. We had a few dips in here early in the spring, followed by a rise to a new high, a new recovery high since the March 2009 low. And the market bottomed at 666, and we got up to over 1360 on the market. And so we had a double, in essence a double from that low, followed by a 20% drop from the April high to the October low. And that's really, in our view, what spooked a lot of investors potentially out of their ideal allocation, their ideal mix, and particularly their ideal allocation of stocks. And so it's no surprise that when you have such a big drop in a short amount of time, that's very unsettling. But as it turns out, 2011 was a flat year in the S&P. So you started at about 1257 or so and ended there. Dow was up slightly, NASDAQ was down slightly. But who would have thought that we'd finish the year flat after this nice double-digit gain followed by a double-digit loss? So that plays into our second slide that we want to show you here, and that's the S&P as represented here by the red line versus gold, and these are both exchange-traded funds, ETFs. So they're approximations for what gold and the S&P are doing. But you can see since mid-September or so, the stock market, as represented in red, is up about 10%. Gold is actually down 10%. And that doesn't make any sense, right? You'd think that as the whole European debacle came to pass in August, September, people would be flocking to gold. And as it turns out, if you've lost money. And so that's very counterintuitive to the messages we're seeing on TV, all the commercials to buy your gold. We here at Infinium have been very skeptical of this. Certainly, you cannot deny a 10-year bull market, which is where gold has been. But nonetheless, the charts would tell you something very different, that the whole notion that you buy gold as a protection when things get rocky has not played out in the fall. So if you're an investor sitting there and you've bought into this idea, the question is, when are you getting back out? Or when are you going to sell that gold? And the markets here at least are telling you that things are getting better. Whether or not it sticks is a whole other story. But nonetheless, one cannot deny the difference in returns. Just when gold is supposed to be doing well, it has hurt investors significantly with a double-digit loss. So that's very telling to us that the market dynamics are different. And your portfolio needs to, if you want to profit, it needs to adjust to this changing market. And that is a market that's changing for the better if you're a bull. So our consideration to your question is, are you too conservative? Have you changed your allocation in the fall when all of this bad news was coming out of Europe and taking the markets for a spin? And the question is if you have gotten conservative, when are you going to get back to your proper allocation? And that's something that we certainly would encourage you to take a look at now, given the recent trends in the market. So thanks a lot for tuning in, and we look forward to seeing you next week.